My compensation and employment are directly tied to the performance of the stock market. Should my investments be diversified into other areas such as real estate? Jacob, thanks for your question. Should definitely think about diversification. We've kind of alluded to that with Rachel's question, right? It doesn't need to be all in stock. It doesn't need to be all in a 5% CD. But sometimes there are situations where employees have massive amounts of company stock. We've seen many 401k plans where the employer match is all in company stock. They've maybe chosen to invest in company stock. Maybe they've had a stock purchasing plan where they were able to get it discounted, right, the purchase price. So there's all kinds of reasons it happens, and I'm not sure what Jacob's is, but if you have accumulated significant amounts of company stock, yes, diversification should be a consideration.
Scott, we had the opportunity to serve a client here at GenWealth just recently that had a massive amount of their liquid net worth, and they had a very substantial liquid net worth. They had a massive amount of their liquid net worth in a single company stock. They also worked at that company. So the fortunes of that entire family, their net worth, everything rode on the back of how that company stock performed. And so that is a untenable situation for just about anybody. I think the general rule of thumb is that you probably ought to own maybe not any more than 10% of your liquid net worth in a single stock of your employer. Now, Jacob actually ask about the diversification into real estate. Mm-hmm. We really do like diversified, professionally managed real estate investments. We think that they have the ability to give the client more spread of risk out to different asset classes other than stocks and bonds. They also can be income producing. So as the rent from those real estate properties come in, that passes on to the shareholder in some substantial percentage. So I think that really you're looking at definitely a diversification question, but I think it's also a professional managed thing that we would lean to.
Yeah, I think that's a real question when it comes to real estate. A lot of people think about, should I have rental houses? And some people are built to be able to do that. It can be a very good investment, but I think you have to ask yourself, how much time spend do I want to have when it comes to this real estate investment? Do you want to buy a house? Do you want to outsource the management of that? Are you going to fix things? Are you going to make sure you rent it? Are you going to go through all of those? And if the answer is yes, then it might be the right route for you. But the real estate investments here for our clients that we utilize are oftentimes the reverse is true. Sometimes they've been in the rental housing game, right? And they're ready to get out of that and enjoy retirement. They don't want the hands-on approach, but they want the value of diversification into an asset class, as John mentioned, other than stocks and bonds. And these real estate investments give a great opportunity to provide that with the distribution, with the professional management, and you get to sleep and not really do anything, just hold it.
Yeah, and Scott, I would also say that fixed income investments, if all of his wealth and income is tied to real estate, then I would be pretty heavily thinking about fixed income investments because we've seen interest rates go up. Fixed income investments are paying in the 5%, 6%, 7% range, depending on how much risk you want to take with fixed income. But that is a great diversifier for someone who is, solidly in a situation where their income and their wealth is dependent upon solely the stock market. Yeah. Stock market is a great thing for long-term benefit, but if you think about it from the standpoint of income and cash flow and things of that nature, then you could be in a problematic situation given the volatility that we've seen lately.
Especially the timing of the bond market right now, because people may be saying, well, wait a minute, didn't you just say the 60-40 portfolio took a big hit in 2022? Yes, and the reason the fixed income component did was because of the rapid rise in interest rates. That has downward pressure on the bond values, right? So moving forward, if you expect a stable or even falling interest rate environment, the outlook on bonds looks a lot different and a lot more attractive.